Okay, we're gonna do a little role playing here today. No, not like that. You're sick. Here's what I'm thinking. Picture yourself as the most badass movie villain of all time. Yes, in this hypothetical, I'm making you the villain, right? It's always better to play the villain, right? Heath Ledger Joker over Batman any day. Swear to me! Okay, now you're this badass villain. You got your crew, you got your hostages, you've taken over this building. It's the typical action movie showdown, right? You got your chopper waiting for you on the roof. Everything, all the chess pieces are exactly the way you want it. Then the phone rings and it's the cops. You answer. Hola, police chief. You must have the wrong number. This is not the donut shop. And the chief answers back. It's the FBI, asshole. Now listen, cut the crap. Why don't you tell us what it is that you want, and we can all go home to our cheating wives, alright, asshole? Okay, now it's time for you to make your demands. As a super intelligent villain, you know, you can't just ask for the money, right? Because what are they going to do? They're going to mark it however they do, and they're going to track it, and they're going to find you, they're going to hunt you down. And second, an exchange will need to be made, hostages for money, and then there's the possibility that that could be the moment where you get captured, right? So you can't ask for that. So how are you going to get that money? What are you going to do? The police chief asks you again. No, look, I can tell you're a nice guy. You don't want to hurt anybody. So tell us, what is it that you want? Suddenly you have your idea. You make your demand. Now listen to me. I want the best investment advice in 4 seconds or less. The police chief is stunned. You must be out of your mind. There's no way we can give you that information that fast. We're gonna have to make a few calls. This is gonna go all the way up to Washington. Best advice. You have 4 seconds. Adios. Ugh. It's an impossible request, right? Just then, I swoop in. The ex-cop vigilante hero who silently takes out your crew, makes his way to you, and then punches you through a plate glass window so fantastically. Dios mío. And then I deliver this epic line to close out the movie. I say, look, if you were looking for the best investment advice in 4 seconds or less, it's to buy and hold low-cost index funds that track the S&P 500 in a registered account, asshole. That's it. End credits. The movie's over. What a production. Did it make sense? No, not really. It was spliced together like a sloppy Tarantino movie. But was there continuity errors too? Absolutely there were continuity errors. This thing was a mess. But was it badass? Still no. But that's the way we do it here on Big Matty Money. Okay, in this video, I'm going to be going through what I've come to believe is the best investment advice condensed into one sentence. And this sentence is meaty, it's actionable, it's not just, buy low, sell high, time in the market beats timing in the market. Those are good little nuggets too, but not as tasty as this meal of a sentence here. Buy and hold a low-cost index fund that tracks the S&P 500 in a registered account. But there's a lot to deconstruct here, so let's take it piece by piece. Before we get started with that, if you wouldn't mind doing a little thumb wrestle to the like button and massaging the subscribe button for me too, and tickle that bell notification icon, that way you get notifications for new videos. Thank you very much as always. Okay, let's take that first piece, buy and hold. Now this is interesting, right? Because you might be thinking buy and hold. Well, aren't I supposed to buy and then sell? Isn't that how I make a profit? Well, maybe, but actually most of the time, no. When you're buying and holding versus buying and selling, you're making a distinction between being an investor and being a trader. An investor tends to buy and hold for a very long time, and only then would they sell, but sometimes they never sell. They keep it, it appreciates, it builds their wealth, and sometimes even dividends that they collect from that could be enough to pay for their bills, and then they would never need to sell that principal investment. Dividends are a portion of a company's profits paid to its shareholders. It's like reward money paid to investors, and most companies will pay that out about every 3 months. And you will keep receiving these during the time you hold those shares. You can take those and then reinvest them. Investors will see a lot of dividends throughout the years. Investors can collect a lot of dividends because they're holding long term, whereas a trader will probably not. A generalization is that an investor is typically long term, lower risk, and a trader is short term, higher risk. I personally am an investor and not a trader. And the reason for that is that in finance, you'll typically come across the sentence that says past performance is no guarantee of future results. And that's very true. It's basically a phrase that someone throws out when they're making a market prediction, and that if they guess they're wrong, they don't want it to come back and bite them on the you know what if someone went and made a investment decision based upon that advice. It's like saying the following may contain coarse language and brief scenes of nudity. Viewer discretion is advised. I absolutely agree that past performance does not equal future results. If you were to make easy money quick on a trade, it'd be easy later on in hindsight to look back and think, oh yeah, I knew exactly what I was doing. But logically, how can you use past models to predict the future when everything is always changing? Another thing to consider when it comes to trading versus investing is that professional money managers do not beat the market often at all, and this is well documented. Only a small handful do, but really for all those other ones, it's not from a lack of expertise. It's just math, really. The investment industry attracts very intelligent people to manage money, but the problem here is that they're all in competition with other intelligent people who manage money. So they're all in competition with each other. And for someone to beat the market and to get above average returns, a lot of other people are gonna have to lose. When it comes to long-term investing, all those short-term wins and losses don't even matter. Okay, so now we know the importance of buying and holding. Let's take the second piece, a low cost. Anytime someone is investing money for you, there is a price to pay whether you see it or not. Any actively managed investment strategy that you have, such as mutual funds, will charge a fee that can be somewhere around 1 to 3%, but usually on the higher end of that. This 1 to 3% is an MER, or management expense ratio. Now, just a few percent doesn't sound like much, but here are some hard truths. Number one, almost all mutual fund managers are not able to beat the market's average return of 8 to 10% annually through trading. Number two, they get paid and take their fee regardless of how they perform. Most importantly, as your investments grow through the years, so do their fees as a percentage, and those will get huge over time. Now, 1 to 3% doesn't sound like much, but over the span of your investment lifetime, that can eat into about 1/3 of your entire nest egg. Right now, this is why you might see those Questrade ads that say retire up to 30% wealthier, richer. This is what they're referring to. So rather than mutual funds, ETFs or exchange traded funds have a very low cost because they are not actively managed. Now, an index fund is an investment that tracks a market index such as the S&P 500. The S&P 500, or the Standard & Poor's 500 index, is one of the most popular indices for the US market. It is comprised of 500 companies from leading industries of the US economy. By buying an index fund that tracks the S&P 500, it's like you're buying the best of the American economy as a whole. The US is the largest economy in the world by far. The top companies are mostly dominated by tech, most of which are the FANG stocks. FANG stocks? You mean vampires? Or should I invest in the Twilight series? Nope. The FANG stocks are an acronym for Facebook, Amazon, Apple, Netflix, Google. The ETF you can buy for this that's available on the Toronto Stock Exchange is VFV. When it comes to MER, or management expense ratio, this is way below the expenses of mutual funds. The MER for this one in particular is 0.08%. That's at the time of this recording. That means, let's say you did your $1,000 minimum deposit into Questrade and you bought it all as VFV. That $1,000 year expense ratio is going to be 80 cents. So that's nothing. You can also see here the past history of when dividends or distributions were paid out, and you'll see how much cash you'll receive per unit held. This is a bonus on top of the actual appreciation or growth of the fund. Now, with dividends, they are treated like income, so you have to pay tax on them. And if your investment grows and you sell shares or units of the fund, then you may need to pay capital gains tax. Taxes all around completely suck, but we have to pay them. Which brings us to our next point, tax sheltering, a registered account. In Canada, let's take the two most popular ones. We have RRSP and TFSA. These both offer tax advantages. The TFSA is tax-free and the RRSP is tax-deferred. Outside of these accounts, so money that's not invested in these accounts or non-registered accounts, any money you make in the form of interest or dividends or capital gains upon selling is taxable. But instead with these, in a TFSA, everything growing in there is tax-free. And with the RRSP, you'll be able to tax defer it and pay tax on it later. So for years, everything will be growing tax deferred. Okay, so buy and hold a low-cost index fund that tracks the S&P 500 in a registered account. And keep reinvesting. This could be the best way to start a financial journey for yourself or for a family or for a friend. Feel free to share this video. If someone did share this video with you and you're that person, hello, new friend. It'd be great if you could memorize this sentence, but I always feel like music is probably like the best way to memorize something. And that's why, as a means of trying to reach out to them younger viewers, I know a lot of you kids seem to be digging the country and rap hybrid that they got going these days. So what the hell's about to happen? Look like some Toy Story shit I'm doing here. Ladies and gentlemen, I'm about to severely embarrass myself, all for the means of education.
Buy and hold a low-cost index fund like a boss that can track the S&P and try to keep it tax-free. Buy and hold a low-cost index fund like a boss that can track the S&P and try to keep it tax-free.
I used to spend all my money on LV. Now I'm all about that index fund, VLV. I love them indices. I love that S&P. In a registered account, max amount. These traders ask me, how you gon' pass me? Investing passively, you gotta switch to actively. You got your sales pitch, I found that infinite money glitch. Compound interest on interest, bitch.
Buy and hold a low-cost index fund like a boss that can track the S&P and try to keep it tax-free. Buy and hold a low-cost index fund like a boss that can track the S&P and try to keep it tax-free. Buy and hold a low-cost index fund like a boss that can track the S&P and try to keep it tax-free. Buy and hold a low-cost index fund.
That's about enough of that. Hey, 2 for 2. Mwah, mwah. Thank you very much for watching. Hope you enjoyed the video and hope to see you come back next time. Thank you. We also have our free tool called Whoop Assets. The link is in the description, so open up a can of Whoop Assets.